ETFs versus mutual funds. Stop asking which is better. Rather, ask this. Most investors get stuck with one very important question. Should I invest in exchange traded funds, which are ETFs, or should I invest into mutual funds? But the real question is, ask yourself, do you want passive investing or active investing? Now, ETFs are like buying the market itself. They track indices like your Nifty or Bank Nifty or PSU banks or Pharma Index, all these. They have lower expense ratios and can also be traded just like your stocks, but they require a demat account and a strong self-discipline. Now, coming to mutual funds. Mutual funds are actively managed funds. There are fund managers, and fund managers select stocks aiming to generate higher alpha, which means higher returns over a longer period of time. They also offer SIPs, which automatically bring discipline, averaging, and the power of compounding for the investors. And that too without worrying much about market timing. Now here is the reality. If you want low cost, market linked and self-managed investings, ETF can be a stronger choice. If you want professional management where the automated investment mode works, or long-term wealth building, mutual funds may suit you much better. Now, the smartest investor do not fight what to choose between ETFs, exchange traded funds, or the mutual funds. They choose the strategy, the process that matches their discipline, goals, and most importantly, the investment style. Because wealth creation is not about choosing the trend. It's all about choosing what you can stay with consistently. Let's decode the myth versus the reality between these two. Now, first myth, ETFs are always better because they are cheaper. Now, the reality to it is ETFs have lower expense ratios, but lower cost does not automatically mean higher returns. There are some active mutual funds which have historically outperformed benchmarks, especially in mid-cap and certain flexi cap categories. Now let's speak about myth 2. The myth 2 is mutual funds guarantee or are taken for granted higher returns. Now the reality is mutual funds aim to beat the market, but many active funds have also failed to outperform their benchmark consistently. Returns does not depend on only fund manager strategy, and it mainly depends upon market conditions as well. Now let's speak about myth 3. SIP is possible only in mutual funds. The reality is mutual funds offer built-in SIP automation. Now ETFs also, many of the brokers have come out where you can do systematic ETF investing through automated buying, right? You can keep like every month or even every day SIP mode also you can keep it in ETFs as well. Now let's speak about fourth myth. ETFs are only for advanced investors. The reality is ETFs are simple index tracking instruments. The only added requirement there, you need a demat and a trading account, and basic investment discipline is required. Now let's speak about myth 5. You must choose either ETFs or mutual funds. The reality is smart investors often use both. ETFs for low cost passive exposure and mutual funds for potential alpha generation. Now, I want you to let me know below what is your thought process on this, and the final truth is there is no best option. The best investment is the one that matches your discipline, your goals, and your investment style. So as this is the best thing, what I want you to know, based on your investment strategy, based on your goals, you can have both or you can have either, right? And if you're smart enough, you can even have mutual funds as well as ETFs also, depending upon your purpose. So I want you to let me know below what is your key takeaway, and also do let me know what are the ETFs or what are the mutual funds you're tracking and you have a plan to accumulate in this 2026. And if you want more these kind of videos, let me know what is that topic which you are more interested. So I'll make a detailed video on that particular topic. I'll meet you again in the next video.